In the previous video, we saw how banks can actually create money by making loans and marking up checking accounts. But in that video, we assumed a few things. First, we assumed the bank didn't need revenues to cover costs or earn a profit. Households and firms don't save or otherwise keep money on them or in their bank accounts. Here, we'll drop these assumptions and look at a fuller picture of how an economy operates through time. So we'll start with the familiar firms or businesses and households. Firms pay households for their inputs, their land, labor, capital, and so forth in the factor markets, as you've seen previously, and households pay firms for their goods and services in the product markets. But as we've seen before, banks play a special role in this in that they make the loans that create the money that gets the whole process started. Now, of course, in a real capitalist economy, this process is ongoing. Banks are making loans to businesses, and businesses are repaying those loans with interests, and banks are making new loans, and so on and so forth. But what we didn't really address in the previous video is the fact that in actual capitalist economies, households are keeping money in the bank through time, keeping money in the bank to make near-term payments, as well as to save and to earn interest that the bank pays them on their savings. The other thing we didn't really look at is that banks will normally need to have some money on hand for a number of reasons. We can think of this as money the bank has in its own account, its reserves, or you could even think of this as cash in the vault if you want it for these purposes. The bank will need that money in any case to make payments, to transfer money to other banks as its depositors make payments, for depositors to withdraw in cash, or to meet regulatory requirements. So banks can get this money by collecting and holding the interest that its borrowers pay to it, but it can also get this money by encouraging households to keep their money in the bank, offering an interest rate to those households. Usually the bank will not pay an interest on checking accounts, but it will on savings accounts, certificates of deposit, what we call CDs, money market accounts, and so forth. So a quick question, what's the difference between a checking account and, say, a savings account? Savings accounts, CDs, and so forth usually come with some stipulations that limit your access to using that money. For instance, you might have to wait 6 months before you can access the money put into a CD without any penalties. So by putting your money into one of these accounts, what you're doing is you're parting with liquidity. You're taking what we call an illiquid position, a not liquid position, where liquidity refers to the ease with which you can access your money. That is, to convert your financial position, your savings or your wealth, into something you can use to buy things or to pay debts. So this brings us to an important insight that Keynes had back in the 1930s. Keynes argued interest can't be the reward for saving money because technically you can save your money in a tin can. Instead, as Keynes argued, interest must be the reward for parting with liquidity. That is, the interest that households earn on their savings serves the function of incentivizing households to keep those savings in an illiquid form, something that limits their access to that money. And what this means is the interest that banks pay to households reflects a balancing of the household's willingness to be illiquid, to be not liquid, as well as the bank's need to have that money, to have reserves from households on hand. And another way of saying that is the bank's need to be liquid. So then, for the bank to make money, the interest rate it charges on the loans it makes has to be greater than the interest it pays on the savings accounts and so forth that households keep. We'll call this interest that banks charge its borrowers R plus K. That's the rates the bank pays on deposits to the households plus some markup. And this three-way interaction between banks, businesses that borrow from those banks, as well as households which save their money in illiquid forms at the banks, gives us an explanation, a theory of interest rates. Now, there's a lot of things that determine interest rates. This includes the risk of defaults on whatever financial instruments we're talking about. It includes specifications of that instrument, for instance, maturity. It includes expectations about the future, for instance, expectations about future inflation. It includes what determines the bank's markup. But for our purposes here, what we'll really be looking at is the willingness to part with liquidity, both on the part of the banks as well as households or really the public more generally, and the desire for liquidity of banks as well as the public.